Hello everyone and welcome to Financial Accounting. In this video we'll start talking about Chapter 11, which covers bonds payable. So bonds payable is one of the forms of long-term liabilities, and we're going to focus mainly on bonds and how we decide on the price of the bond. I think that's the main purpose of this chapter. So a bond is a form of interest-bearing note. So in other forms, or in other words, it's a note that bears interest. So we expect to pay interest, or the issuer of the bond to pay interest. Like a note or a note payable, a bond requires periodic interest payments with a face amount to be repaid at the maturity date. As creditors of the corporation, bondholders' claim on the corporation assets rank ahead of stockholders. So if the company files for bankruptcy, those who would be paid first are the bondholders before the stockholders. And that's one of the strengths of becoming a bondholder. The only problem is stockholders, they're owners, bondholders are lenders or creditors to the company. So you don't really have a big share of the profits or anything. You just get a fixed amount of return on the bond, or the amount you invest in the bond. So corporate bonds normally differ in face amounts, interest rates, interest payment dates, and maturity dates. And we'll see examples for all of that. Bonds also differ in other ways, such as whether corporate assets are pledged in support of the bonds. So as a collateral, sometimes a company would have an asset that's pledged against the bond. So if anything goes wrong, at least the bondholder would be able to get this kind of asset. So a bond issue is normally divided into a number of individual bonds. The face amount of each bond is called principal. This is the amount that must be repaid on the dates the bond mature. So remember, the term principal is like the face value of the bond, which is how much the company or the issuer of the bond should pay the bondholders at the maturity date. The underlying contract between the company issuing bonds and the bondholder is called a bond indenture. And please remember that this is like an agreement. The bond agreement is called a bond indenture. The two most common types of bonds are term bonds and serial bonds. When all bonds of an issue mature at the same time, they are called term bonds. So they have a term that they end on. If the bonds mature over several dates, they're called serial bonds. It's like sequential. There are also a variety of more complicated bond structures. For example, there's something called convertible bond, which may be exchanged to common stock. And there's also something called callable bonds that can be called back or redeemed by the corporation prior to maturity. So let's assume that the interest rate goes down. The company might feel like they don't want it to pay too much interest, especially that the interest rate, the running interest rate right now is lower, and we can borrow at a cheaper cost. So they have the option sometimes to call back their bonds. So of course, as a bondholder, that's not a very good feature. But for the company issuing the bonds, of course, this is a feature that gives them some kind of advantage. So we expect that callable bonds would not be very favorable, or cannot be perceived favorably among bondholders. When a corporation issues bonds, the proceeds received for the bond depends on three elements or three factors. So this is where we're talking now about the proceeds, or the cash received from issuing the bond. The main element, or the main component, is the face amount. So the face amount of the bond, which is the amount due at the maturity date, which we call it also the principal. Okay. The second thing is the interest rate on the bonds, how much it's paying interest. And the third rate, or the third factor, which might be a little bit deceiving here, is the market rate. And people might think, oh, how is it important, the market rate, compared to the interest rate of the bond? The market rate has an impact on setting the price or the proceeds to be expected from issuing the bonds, because if the market rate is higher than the interest rate issued on the bond, then our bond is less attractive. And if the market rate is lower than the bond the interest rate on our own bond, then in this case, it's more attractive. So if it's more attractive, more people are interested in it, and in this case, the proceeds might be higher. So remember these three things: the face amount, interest rate, and the market rate. The face amount and the interest rate on the bonds are identified on the bond indenture. So in the agreement itself, we know the face amount and the interest rate. The market rate is the market rate. It's something out of the control of the company. So the interest rate to be paid on the face amount of the bond is called the contract rate or the coupon rate. So remember, interest rate, contract rate, coupon rate, they all have the same meaning. The market rate of interest, sometimes called the effective rate of interest, and sometimes they also call it the yield. So either market rate, effective rate, or yield, they all have the same meaning. It's the rate determined from sales and purchases of similar bonds. Not this bond, but other similar bonds. And of course, it might be higher or lower, depending on the situation. So the market rate of interest is affected by a variety of factors, including investors' expectations of current and future economic conditions. So sometimes the interest rate will go up, sometimes it goes down, depending on mainly the economic condition. If the market rate equals the contract rate, so let's say we have the stated rate or the effective rate of the bond is the same as, or I need to correct myself here, the stated rate on the bond, if it's exactly the same as the market rate, then in this case, the bond is going to be sold at its face amount. So let's say the face amount is $1,000, it's going to be sold for $1,000. If the market rate is greater than the contract rate, then the bond will sell for less than their face value. Why is that? Because if the market is more attractive than the coupon rate or the contract rate, or the rate that's stated on the bond, then people might be reluctant to invest in our bonds or in the company's bonds. So in this case, the bond has to be sold in an amount less than its face value. And in this case, we say that it's sold at a discount. So the face amount of the bond less the selling price is called a discount. A bond sells at a discount because buyers are not willing to pay the full face amount for bonds with a contract rate or coupon rate that's lower than the market rate. If the market rate is less than the contract rate, which is the other scenario, the bonds would sell for more than their face value. Why is that? Because in this case, the bond of the company is more attractive than the market. It pays higher interest rate compared to the market. So we expect a premium in this case. So the selling price of the bond less the amount is called a premium. A bond sells at a premium because buyers are willing to pay more than the face amount for bonds with a contract rate that is higher than the market rate. So try to remember these three scenarios. The middle scenario is when the market rate is equal to the contract rate or the coupon rate. So in this case, the selling price would be the same as the face amount, which is, let's say here, it's $1,000. So the bond is going to be issued or sold for $1,000. If the market rate is higher than the contract rate, then we are less attractive compared to the market. So we expect that the bond is going to be sold at a discount, which is a value below $1,000. So let's say $920. If the market rate is less than the contract rate, then in this case we are more attractive than the market. And in this case, it's going to be sold at a premium. So a $1,000 bond or a bond with a face value of $1,000 can be sold for like $1,100 or $1,080 or $1,050. So any value above the 1,000. So let's see the accounting side of this. Bonds may be issued at their face amount, a discount, or a premium, as we mentioned before. When bonds are issued at less or more than their face amount, the discount or premium must be amortized over the life of the bond. The term amortized is very similar to depreciation. It's like we split the value over the life of the bond. At the maturity date, the face amount must be repaid. Or in other words, the $1,000 has to be repaid. So let's see this example. And let's start with an example where the market rate of interest is equal to the contract rate. And in this case, we expect that the bond will sell for their face amount. Or sometimes we call it at a price of 100. The 100 here refers to 100%. It's not $100. It's 100%. And for some reason, in the bonds business, they don't use the percentage when they want to show if it's issued at a premium or a discount. But of course, if it's issued at 100, then this means that it's issued at its face value. So assume that on January 1st, year 5, Eastern Montana Communications Incorporated issued the following bonds. The bond has a face amount of $100,000. The contract rate of interest is 12%. Interest is paid semi-annually, which means twice a year, on June 30th and December 31st. The terms of the bonds are 5 years, and the market rate of interest is 12%. So you can see here that the market rate is equal to the contract rate, so we should expect that it's going to be issued at the face value, which is the 100,000. One thing I want to ask you here, and I want you to think about, if this is semi-annual, so how many times do you think this bond would pay interest? The term of the bond is 5 years and it's paid twice a year, so expect interest to be paid 10 times during the life of the bond. The other thing that I want you to remember, the interest rate is 12% for the year. That's the annual interest rate, and of course it's going to be divided by 2 for every 6 months. So since the contract rate of interest and the market rate of interest are the same, the bonds will sell at their face amount, which is the 100,000 in this case. The journal entry to record the issuance of the bond would be as follows. And here we're looking at it from the perspective of the company issuing the bonds. They're receiving the cash, so they're debiting cash for $100,000, and they're crediting bonds payable for the same value, which is $100,000. The interest rate is not to worry about right now, because when you issue the bond, you don't need to worry about the interest rate payments. So this is going to be later on once we make the interest rate or the interest payments. But remember, bonds payable is a liability, and that's why it's on the credit side. So every 6 months on June 30th and December 31st, after the bonds are issued, interest of $6,000 would be paid. How did we get the $6,000? We get the face value, which is the $100,000, multiplied by 12%, which is the stated rate, or the coupon rate, multiplied by 1/2, which is because it's semi-annual, and in this case it's going to be $6,000. So we debit interest expense, and remember, expenses are always on the debit, and we credit cash because the company is paying cash now. And remember, this is June 30, the next one would be December 31st, and then the following June 30 and December 31st, and so on for 5 years. At the maturity date, which is after 5 years, the payment of the principal of $100,000 is recorded. And it should be straightforward. On year 9, December 31st, which is after 5 years, we are going to debit bonds payable, and by debiting bonds payable, we're canceling the bond, and we credit cash, so we're making a payment of $100,000. So we're getting rid of the bond payable, and we are making a payment on the credit side for $100,000. Now let's see the situation for a discount. So if the market rate of interest is greater than the contract rate of interest, the bond will sell for less than their face amount. And I always like to use the term less attractive to the market. People or investors might not really become interested in our bond or the company's bond if it issues interest rate that is below the market. So for the business to be able to issue this bond and make it attractive to investors, the only way is that it has to be discounted. So to explain that, this is because investors are not willing to pay the full face amount for bonds that pay a lower contract rate of interest than the rate they could earn on similar bonds, which we call it the market rate. The difference between the face amount and the selling price of the bond is what we refer to as the bond discount. So let's see a numeric example. So assume on January 1st, year 1, Western Wyoming Distribution Incorporated issued the following bond. Again, $100,000 face amount, The contract rate of interest is 12%. Similar to the previous example, interest is paid semi-annually on June 30th and December 31st, which means twice a year. The terms of the bond are 5 years, so we expect 10 interest payments. And the market rate of interest is 13%. So 13% is higher than our interest rate, than the stated interest rate, and the coupon, or the contract interest rate. So because it's less attractive, we expect that the issuing price, or the proceeds that are going to be received from issuing these bonds, are going to be less than $100,000. So because the contract rate of interest is less than the market rate of interest, the bonds will sell at less than their face value, or their face amount. Assuming that the bond sells for $96,406, and this is given to you, the entry to record the issuance of the bond, it would be as follows. We're going to debit cash, which is based on the $96,406, which is the cash received. We're going to credit bonds payable for the full amount, because after 5 years we have to pay the full $100,000. And the discount on the bond would be the difference between this value, and it's a plug-in amount. And remember that discounts are always recorded when issuing the bond on the debit side. In the case of a premium, it goes on the credit side. So the $96,406 is the amount investors are willing to pay for bonds that have a lower contract rate of interest, which is the 12%, than the market rate, which is 13%. The discount is the market's way of adjusting the contract rate of interest to the higher market rate of interest. So the discount on bonds payable is a contra account to bonds payable and has a normal debit balance. So see, this is a contra account to the bonds payable, and we should expect the discount. And remember that it starts with the letter D. It's easy to remember. When issued, it has to be recorded on the debit side. We're going to amortize it, and when we amortize it, we're going to credit it later on, which is a way of reducing it. So again, one more time, the discount on bonds payable is a contra account to bonds payable and has a normal debit balance. It is subtracted from bonds payable to determine the carrying amount, or the book value of the bonds payable. So what is the carrying amount of the bond? It's the face amount of the bond minus any unamortized discount, or plus any unamortized premium. So let's see how we're going to record that. So every period, a portion of the bond discount must be reduced and added to interest expense to reflect the passage of time. And that's what this is how we deal with the amortization of the bond discount. The process called amortization increases the contra rate of interest on a bond to the market rate of interest that existed on the date the bond were issued. And the journal entry to amortize the bond discount would be as follows. We're going to debit interest expense and credit discount on bonds payable by this amount. And remember, this is just a journal entry we record to amortize the bond discount. The preceding entry may be made annually as an adjusting entry, or it may be combined with a semi-annual interest payment. In the latter case, the entry would be as follows. In other words, if we combine it with a semi-annual interest payment, in this case we're going to debit interest expense, credit cash, based on the amount of semi-annual interest. And keep in mind, we calculate the cash based on the face value of the bond multiplied by the contract rate. And the difference would be the discount on bond payable. So the discount on bond payable would be the amount of amortization. We add these together, and that would be our amount of interest expense. Remember, the discount on bond payable originally has a debit balance, but we're amortizing it, that's why we credit it. So the two methods of computing the amortization of a bond discount are the straight line method of amortization, and the other one is called the effective rate method. For simplicity, we're just going to cover the straight line method, which provides equal amount of discounts or premium to be written off to interest expense each period. The effective interest rate on the other side, sometimes we call it the interest method, is required by GAAP. And again, for the sake of this class, I'm not going to focus too much on it. For those of you who are going to major in accounting, then this is something that you will be doing more often. So the amortization of Western Wyoming distribution bond discount of the 35,904 is computed as follows. So the discount was 3,594. Remember, the term of the bond is 5 years, but it's semi-annual, so it's twice a year, so we multiply 5 by 2, and that would be 10 periods. So we take the 3,594 divided by 10, and that would be the semi-annual amortization. So every 6 months, we're going to amortize the discount by this amount. So the 359.40 is the amount that's going to be amortized every 6 months. So the combined entry to record the first interest payment and amortization discount would be as follows. We're going to record the cash on the credit side, and I'm starting with the cash because that's the easy way to record this journal entry. So we start with the cash, and remember, the cash is based on your the face value of the bond, which is 100,000, multiplied by 12%, which is the contract or the coupon interest rate, and multiplied by 6/12 or half, and that would be 6,000. Why did we multiply by half? Because this is like bond is semi-annual, pays semi-annual interest. And then we amortize the discount on the bonds payable on the credit side for the 359.40 cents based on the calculations that we just made here. And then we add these two numbers, and that would be the amount of the interest expense, 6,359.40 cents. So the preceding entry is made on each interest payment date. Therefore, the amount of the semi-annual interest expense on the bond of 6,359.40 cents remain the same over the life of the bond. So the effect of the discount amortization is to increase the interest expense on every semi-annual interest payment. If, in effect, this increased the contract rate of interest to a rate of interest that approximates the market. As the discount is amortized, the carrying amount of the bonds increases until it equals the face amount of the bonds at the maturity date. And then, at the maturity date, we just pay the full amount, which is $100,000. So let me stop here. In the next video, we're going to be covering the case of a premium.